Here is the scenario we're working with. Here's our timeline. This is the month of August. On August 1st, we began our period with, 20 units at $91 each. So those are purchases that happened in the previous month that went unsold and rolled over to the current month. So $91 times 20 is $18.20. And then on August 3rd, we have a purchase, 15 units at $106 each for a total of $15.90. We have our first sale on August 7th. We've sold, 20 units, 5 times 4, 20 units for $130 each for total revenue of $2,600. And then we're back to purchase. On August 17th, we bought 20 units at $115 each. Another sale, August 20th, we sold 15 units at $140 each. $2,100 is our total revenue. Another purchase on August 25th, 15 units at $125 each for a total of $1,875. Our last purchase, just 5 units at $119 each, $595. And then we've got our final sale. On August 30th, it is 25 units, big sale, 25 units at $150 each. So that is $3,750 of revenue. So here's our timeline that we're going to be working with in this problem. This is periodic FIFO. We begin with the cost flow. I'm using the X formula again. Beginning inventory. First, on the left in units, 20 units, and on the right in dollars, $18.20. And then we do our purchases. So there's 15 here and another 20 here. That's 35, and another 15 here. That's 50, and another 5. That's 55. So 55 units that were purchased. And then we can do the same thing in dollars. $1,590 plus $2,300 plus $1,875 plus $595 is $6,360. So the top 2 numbers equal available for sale. 20 units in beginning inventory and 55 units bought, 75 units available to sell during the month of August. Over here, those units cost us in beginning inventory $1,820, and then the ones we purchased $6,360 for a total of $8,180. That's the cost of the units that are available for sale. This is the important of the two. This is more important because we record our inventory amounts in dollars, not in units. So we're trying to get to these 2 bottom numbers down here. This 8180 either went to ending inventory or it was sold. We don't know which one yet. We have to do periodic FIFO first. Periodic FIFO. The periodic method says it doesn't matter when the sales occurred during the period. We're going to account for everything at the end of the period. So we just pull all those sales together at the end of the period, and we apply the FIFO method. So the FIFO method says first in, first out. So first in means the oldest units. We are trying to come up with the cost for 60 units because that's what we sold. 20 and 25 is 45, and another 15 is 60. So 60 units is what we sold. We need to come up with the cost of 60 units, and we're going to start here and work our way from the oldest to the newest purchases. We're trying to get to 60. There's 20 right there. So we're going to take these 20 units. And now we need 40 more. There's 15 right there. We're going to take these 15 units. These are all sold. I already forgot what I was doing here. What is that? 35. And we're trying to get to 60. So that's another 25. There's 20 right there. So we're going to take these. And we're looking for 5 more. We need 5 of these. So here in yellow are the costs for 60 units. And under them, the revenue for 60 units. What remains is the unsold ending inventory. So let's do the calculations. Let's start with ending inventory. We've got 10 units at $125 each, $12.50, plus we didn't sell any of these. So the full $5.95 plus $5.95. $18.45 is our cost of ending inventory using periodic FIFO. We can subtract 8180 minus 1845. $63.35. Should be our cost of goods sold, because that 8180 went to one of two places, ending inventory or cost of goods sold. But let's double check that. This is 5 units at $125 each. That's a cost. So remember, we're coming up with the cost of the 60 units that we sold. So I'm going to go 5 times 125 plus that 2,300 plus 15 times 106, that 1,590 plus 91 times 20, that 1,820. 63.35. That's our cost of the units sold, cost of goods sold. Now I can write the journal entries. Remember, when we make a sale, when a retailer, when a merchandiser makes a sale, there are 2 journal entries that we need to make. First, we've got our sale journal entry. So we're going to call this a cash sale. We're going to record cash in with a debit, and we'll record sales increasing with a credit. Our sales, 2,600 plus 2,100 plus 3,750 is 8,450. Our cost is the second journal entry we need to make. And our debit will be the expense account called cost of goods sold. And the amount is $63.35 from right there. And our credit is the asset account called merchandise inventory for the same amount. What we're doing with this journal entry is removing those 60 units at a total cost of $63.35 out of merchandise inventory and moving them over to the expense account called cost of goods sold. And while we're doing journal entries, there are the purchase journal entries. We had 4 purchases: August 3rd, August 17th, August 25th, August 28th at those amounts. This is what the journal entries look like when we made the purchases. That is periodic FIFO.